Hi everyone, Shaun Humphries here. Welcome to this edition of the All Things Retirement Podcast. In this edition of the podcast, Thomas Holmes, a CPA and a member of the high-powered team Assante Private Client who consults widely with business owners and other professionals, we are going to talk about maximizing on the capital gains exemption. So if you are a small business owner or incorporated professional and you want to get some ideas about how you can maximize tax planning opportunities, particularly down the road if you end up selling your business and using those assets to fund your retirement dreams, then you'll want to make sure you listen to this podcast where we talk about the capital gains exemption and how you can get your company ready to fully maximize on that tax planning opportunity. Well, hi everyone, Shaun Humphries here. In this edition of the All Things Retirement Podcast, it's a real pleasure for me to have Thomas Holmes join us on this particular podcast session. And today what we're going to do is we're going to begin focusing on a series of talks that really will really get into the details for incorporated professionals and business owners and how do they begin planning their tax situation to get ready for retirement. And it's not one of those things that just kind of comes together just out of the blue. There's very intentional planning that goes into getting ready to retire if you're incorporated. And Thomas, of course, his background is a CPA, he's a CA, and he's for years worked with incorporated professionals and business people to help them transition to retirement and to get all those ducks lined up to make that transition. So Thomas, thanks so much for joining us on the call.
Thanks for having me, Shaun.
One of the things I wanted to talk to you about is we talk about the tax planning. Of course, for small business owners, there's something called the super exemption or small business capital gains exemption. And of course, when I've worked with clients in the past, I've come to understand that it's not something that just happens overnight. There's some very intentional planning that goes into trying to maximize these capital gains exemptions for small business owners. So I thought I'd just have you kind of unpack for us just some of the key points that people need to keep in mind to get ready for that sale or that transition from their business.
Absolutely. I think when dealing with business owners, the one thing that we want to make sure they can capitalize on is the lifetime capital gains exemption. At this point, we're talking about gaining an exemption on $813,600 worth of capital gains. So it's something that we want to make sure that business owner does not miss. So the one topic we often will talk about is this concept of purification. When we talk about purifying a business, we're talking about making sure that corporation holds the right type of assets. The asset that we really want to make sure, the assets we really want to make sure they avoid are things like cash and investments that the CRA would deem to be inactive for business purposes.
So when you say inactive, so they'll look at assets that generate like real business income. So if you're a manufacturing company, it's assets that generate the revenue from manufacturing.
So your working capital and things of that.
So you can't include things like interest income or dividend income.
Yeah, it's so there's three main tests, I guess, taking a step back, and the tests, two of the tests really deal with the percentage of assets in that corporation that are used in active business. So active business for the CRA's purposes are assets, like you said, that are used to generate income. So as soon as we see a corporation that is still operating but maybe accumulating too much cash, too many investments, at that point we want to be concerned. So there's a few ways that we can kind of get around this test. But as you said, it doesn't happen overnight. The first test requires that the corporation have at most 50%, or have at least 50% of its assets used in active business for the 2 years leading up to sale.
Okay, so 2 years. So if I'm a business owner and I may not be actively looking for a sale of my business, but this is the right offer comes up for me, and it's an offer I can't refuse. You're telling me that if that offer came up today and I haven't done my homework over the last 2 years to get ready for the sale, I might be stuck a little bit. So,
absolutely.
So either going to end up paying potentially more tax than I need to, or I have to delay that sale, which is not necessarily a great option if somebody's ready to buy.
I agree, and that's why we want to make sure that the corporation is staying purified on an ongoing basis. This is not a last minute thing. 2 years, and there's no getting around that. So if your corporation is holding a lot of cash or investments, and you expect to sell or even don't expect to sell, if that offer comes out of the blue, you could be missing out on a massive tax advantage when, as we know, there's not a lot of these hanging around.
Yeah, no, exactly. Okay, so 50% test, 2 years out. Are there any other tests you have to be aware of?
There's also There's two other tests. The first test is always have you held those shares for at least 2 years. For the most part, this isn't a big concern for business owners. But the third test is at the time of sale, you have to get your corporation to the point where 90% of the assets have been used in active business. So that's one that we can plan for last minute, and which involves a few different tax strategies.
Okay. So again, that's the 10% test. There's a little bit of flexibility around that, but there is some planning that has to be done. So tell me, when as a business owner, of course, business owners are always keeping cash balances on the side for business opportunities, emergency funds, just in case kind of capital. How does CRA view sort of the difference between a passive cash position and cash that's needed for operating the business? Are there rules of thumb that accountants have?
That's a really good question, and I think that it's one of those situations where the CRA would base it on the facts of that situation. So there's really not hard and fast rules, but I think that you would have to be able to the business owner would have to be able to make a case that cash is on hand to generate active business. Generally, holding cash for investment purposes would not qualify. Generally, the rule of thumb that we like to see is the cash on hand should be there, or should not exceed the current liabilities on hand. So we want to make sure that any cash you have would be there to satisfy current liabilities, rather than holding cash as a just-in-case fund. Generally, the CRA would see that as holding for investment purposes. In a lot of situations, we'll see business owners move that excess cash into a separate holding company or out to other family members in order to keep your corporation on site.
And I guess there'd be a lot of planning around that strategy, right?
Absolutely, and that's we hope there's not a lot of do-it-yourself tax planning in those situations. If you're looking to, if you think the capital gains exemption is something you want to take advantage of because you're going to be selling to a third party one day down the road, we'd want to make sure that you'd sit down with the correct professionals.
Perfect. So again, we've talked about this, these strategies to purify, to maximize the capital gains exemptions, and clearly it's not something you can do last minute. And so if you're getting close to the point where you're beginning to think about selling your business, then you want to start getting your ducks lined up to maximize these tax planning opportunities.
Absolutely.
So again, Thomas, thanks so much for sharing this tip for us.
You're very welcome, Shaun.
Well, that concludes this edition of the All Things Retirement podcast. Hope you found the content helpful. I think Thomas did a really good job at a high level to unpack the whole area of maximizing on the capital gains exemption. If you're a small business owner, incorporated professional, it's a really critical area, and particularly as you grow your business and if you're going to transition to retirement, taking full advantage of these tax planning opportunities is absolutely critical. So again, I hope you found the discussion helpful. Now, how do you take this information from sort of the high-level discussion to the practical runway application of these strategies? Well, we've developed a comprehensive retirement planning process that we call Game Plan. And so if you're interested in talking to someone about how you can get ready for retirement and how you can effectively integrate your corporate assets and your corporate planning to your personal planning, then Game Plan is for you. As well, Assante Private Client collaborates with us so that when we're talking to business owners and incorporated professionals, we can actually deliver some very precise tax planning strategies that you can apply to your personal circumstances. It's often surprising to us that accountants and lawyers who many business owners have been dealing with for years aren't always addressing these key issues about how do you actually integrate your corporate assets, your RSP accounts, your tax-free savings accounts, and your non-registered assets into one comprehensive retirement income plan that not only ensures your income security, but also maximizes on your tax planning opportunities. So if you'd like to have a discussion on the Game Plan process, don't hesitate to visit our website at www.shaunhumphries.com. There's information about that process and service on the website. Don't hesitate to send us an email. Email contact information is on this presentation. As well, you can find it on our website. So all the best as you plan for retirement and maximize on the opportunities.